Hey guys, Brett here with Numbers Up Finance. Today we're going to be looking at the NASDAQ 100 daily chart again. I want to go over one of the trade ideas I set forth in yesterday's video. I talked about a long here at the bottom of this impulsive candlestick on Monday. I'll zoom in for you. Talked about long here at the bottom of this Monday, an impulsive stick that usually meets at a support. That's what I would have expected to bounce off of, especially because the bullish indicators we were seeing here on the MACD. The first day it started to play out, and then today you could see failed quite a bit. I got stopped out at around 155, and it continued to sink below that. Now I want to attribute this sink for a fact today on December 19th, Wednesday, the FOMC.
So you're building wind turbines.
I do not have ad blocker. The FOMC, it's the federal committee that is in charge of the national interest rate. The Fed increased the rate from 2% to about 2.25, I believe, or it might have been 2.25 to 2.5. Either way, when national interest rates are increased, that means, people looking to borrow money are now borrowing money with higher interest rates. That means less people are going to borrow money. If less money is being borrowed, that means there's less spending. So typically any hike in the Fed rate is going to cause a decrease in the stock market. So that was announced today around 2:30. I was paying attention to that on, I have Yahoo Finance. It's an app I have on my phone. Keeps you updated to let you know when stuff like that's happening. I was watching it live between like 2 and 3 o'clock today, Eastern Standard Time. I could see where I probably should have predicted that. People were in favor of that. Not in favor, but they were saying the probability of it was that the rates were going to be hiked, and thus we should have expected this drop. For a couple of reasons, I expected it not to happen. First of all, since the last time that the Fed was hiked, it was September 26th, I believe. Correct me if I'm wrong, but that is what's catalyzed this first initial drops in the market. It's what caused this correction. And I figured that now here on Wednesday, this is where we open Wednesday. To me, it seemed that a drop of about 15%. I did not think that would, spark the need for another Fed spike. Even though they had announced at a meeting, the FOMC, they had announced that they were about 70%. 70% chance likely to hike it again. It still didn't seem worthwhile to me, but I'm not a member of the federal government. Even Donald Trump was discouraging the spike, but then again, they probably know best. He said the decision was made based on data, solely on data. He didn't want politics involved, anything along those lines. These are smart people, so in the end, it'll be the healthiest thing for the economy to keep interest rates high, keep inflation down. But that's the reason we saw this impulsive candlestick. So I want to get into the MACD a little bit and explain this. MACD is a momentum indicator, and momentum in a market is essentially explains where the market is supposed to be in comparison to where it is. A momentum indicator, obviously, trading is not a perfect science. The market doesn't move in a 100% predictable manner. There's psychology involved. People trade when they're scared. People trade when they're greedy. And it doesn't follow. It's not as systematic as it's supposed to be. A momentum indicator essentially shows when people are being too fearful or when people are being too greedy. Here I've been talking about the bullish divergence. We see prices making lower lows, and we see on the MACD, look, watch, you can trace from peak to peak as these prices make lower lows here, 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 and here. we see that the MACD is making higher lows. That is what you call a bullish divergence. It means that we are overextending downwards. It means people are panic selling. It means we are further down than the market likely should be. And that's why I was in favor of a bullish run, a bullish reversal. Essentially, every time the Fed is raised, people are going to, panic sell out of fear, because ideally it should decrease spending in the market, and you'll see a decrease in the market due to it. People were ready for this Fed hike. It was announced, well near the September Fed hike when we witnessed these first drops. People were well aware it was going to happen. It was even announced that there was a 70% chance that it would happen. People knew it was coming, and likely that is why we were overextended downwards in such a manner. People were preparing for it. Either way, once it still happened, we saw another day of panic selling here with this largely impulsive bear candlestick. If you still do look at this MACD indicator, we see yet another lower low on the prices. And there's still potential for this MACD to make a higher low. Again, this momentum would have to drop all the way to this level here, which is a pretty significant drop. Prices would have to decrease quite a bit further than they are now, in order for that bullish divergence to fail, and instead we'll just see a bearish convergence. Essentially, the momentum is agreeing with the prices, and we are where we're supposed to be. Let's see. So, I would still like to say that since we saw this impulsive candle on QQQ that met at a key support level here, 154, I will show you why that's a key support. We track it all the way back to here. It is the lows that we witnessed in April, and it is also relatively close to where these candles were closing in our 2018 low. Obviously the 2018 low is down here around 150.13, but you can see that's just the wick that made it down here. It's a very sharp intraday spike. So when we look at close prices, which are typically a lot more significant than intraday prices, this line of 154 is a loose support over here, very tight support over here, and thus the fact that we closed at it today, that makes it even more significant. And typically I will always trade an impulsive candle an impulsive downward candle that meets at a support. I will always trade against that. So after being stopped out of this trade, I did go right back into a long before close. Let's see. I would also make the argument that we will not go any lower, because SPY, this is the SPX, it represents the top 500 stocks on the market. It's much more diversified than QQQ. The only reason I trade QQQ is because there's a little bit more price fluctuation, more risk reward. Oops, you can see that. Here on SPY, we have about a 15% drop. But if you look at QQQ, it's over more around 20%. So there's just more room for profits to me, and that's why I trade QQQ. QQQ is a lot more tech heavy, where SPY, is the top 500. There's a board, a committee that selects. It's not just the top 500 most valued stocks on the market. They diversify it with the financial market, the retail market, staples. They include all the 11 sectors in there and try to diversify it as much as possible. So this is overall a better look of the market, and we see that SPY dipped well below its 2018 low here. This is the lowest it ever was, down here at about 252. We dipped all the way down to 249 today, a very impulsive move, panic selling, but then we came back up and closed a little bit closer to that 250 level. There's a possibility that we see further panic selling. So I put low risk into this trade when I went long. I don't think QQQ has any more business dropping down to 150, considering SPY has already hit its 2018 low. But if there is more panic selling tomorrow due to the hike in the Fed, our next level of support is here at this 146 marker, and I'll show you where I got that from. If we look at the weekly chart that pulls out to 3 years, we see that our next line of our next price line that has any significance at all is a resistance around this right here, and we see another resistance here as these wicks tested a couple times. That's the next strongest price zone I could see. So if there does continue to be any panic selling, I wouldn't expect it to go any lower than 146.4. So under the circumstance that the market was prepared for this, there's some inexperienced traders in the market, obviously, who are still going to panic sell when they hear the Fed has increased. That's why we saw the red candle we did today. I believe this is as low as it will go. We still see on the MACD momentum indicator there would be that significant drop to 164 in order for that bullish divergence to to have failed, for that indicator to have failed, and I don't think that's the case. I do still believe we are overextended downwards. I'm not so confident anymore that this year will close positive. Let's see, I'll trace this back to. Here is the open price for the year, roughly 156. We are down at 154. Actually, maybe I am confident with that. That's not a lot of gap to fill in order for a positive year. When announcing this spike in the Fed today, Powell, he's the head of the committee, he talked about how 2018 was a very, very strong year for the economy, regardless of this giant dip, since the September spike in the Fed. So I'm still confident that this year will finish positive. Not confident necessarily, but I would assume so. Thus, I'm still long off this impulsive stick that met as a support. We could see a jump back up to 156. That's a small gain. A jump up to 162. Again, 166 would be a favorable sell zone there. That's roughly where it's going to meet that 50-day SMA. It's also the previous peak here. If you see, there's a tiny, intra-week spike here. It comes back up to around the 166. And for a bullish divergence to play out, the prices are going to have to make higher highs. Indicating that we at least need to get to this level or surpass it a little bit. So let's see. So I think that's all I wanted to cover today. I was stopped out of the trade earlier, so that was a failed trade. But again, I would have gone in on that trade. Maybe a little bit more cautiously next time, knowing that the Fed was there. Again, if you want to pay attention to something like that, there's lots of apps out there that can keep you updated on financial news. Like Yahoo Finance, and I'm sure you can Google. I use Yahoo Finance. It's very convenient. I get notifications, and I was actually just able to open it up right at like 2 o'clock, and watch the whole thing live. So I knew what was going on. So other than that, still optimistic for a bullish run at the end of the year here. Definitely be careful, pay attention to the market in the next couple of days, watch for panic selling, things along those lines. Going long from this 154 price level, that is inconvenient. I'd say an ideal stop would be, maybe at the bottom of this candle wick here. If it dips below, anywhere below that, maybe give it a little breather room, just because remember, this market is extremely volatile. So if you think this video was helpful, like, subscribe, comment, let us know. We should keep doing it. And thanks for watching. Get your numbers up.